All right, we've all heard it a million times. Buy low, sell high. But here's the thing, almost no one actually does it. Today we're going to dig into the psychological reason why that super simple advice is so incredibly hard to follow. And, more importantly, how you can actually master it.
So let me start with a question for you. Just imagine your favorite clothing brand has a massive 50% off sale. You'd be sprinting toward that store, right? Eager to grab a bargain. But what happens when the stock market has a 50% off sale? Well, most people do the complete opposite. They run for the hills. So what is going on there?
I mean, it's the mantra we all know. It's investing 101. Buy something when it's cheap and sell it after it goes up in value. Sounds simple, logical. You'd think it's foolproof.
But here's the kicker. Almost nobody actually pulls it off. The vast majority of investors end up doing the exact reverse. And this has nothing to do with how smart you are or how much you know about finance. It's all about human psychology.
You see, this is where our brains just seem to split in two. When we see a sale at a store, our brain screams opportunity, value. We get excited, and our immediate action is to buy. But when the market drops by that same 50%, our brain frames it as a crash. It switches into full-on danger mode, triggering panic, and the urge is to sell. It's literally the same math, but it's a completely different emotional story.
And this brings us to what's often called the investor's paradox. So let's really unpack the two powerful emotions that hijack our logical thinking, especially when the market takes a nosedive. First up is the big one, fear. When prices are falling, our ancient survival instincts kick in. The headlines are screaming, crash, your portfolio is a sea of red, and every fiber of your being is telling you to get out now. Fear turns what should be the best buying opportunity into what feels like the absolute riskiest moment, and it paralyzes us from taking advantage of that sale. Now, on the flip side, you've got greed. When the market is soaring and everything's going up, that's when the fear of missing out, FOMO, takes over. We see other people making a ton of money, and we think, oh man, if I sell now, I'm going to miss out on even bigger gains. This greed convinces us to hold on way too long, and it stops us from ever actually locking in our profits.
So when you combine these two powerful forces, fear and greed, you get a perfect recipe for disaster. Fear makes you sell when things are low, and greed, fueled by FOMO, makes you buy when things are high. You end up doing the exact opposite of the one simple rule you were supposed to follow.
And this chart right here shows you exactly how that plays out in the real world. Look at where investor activity peaks. It's right at the market high, when greed is running wild and everyone is jumping in. Then look at the market low. Activity completely plummets as fear takes over. People are either panic selling or they're just too scared to even think about investing. This is the emotional cycle of buying high and selling low in a nutshell.
Okay, so that's the problem, and it's a deeply human one. But how in the world do we escape this emotional roller coaster? Well, the answer is surprisingly simple. You have to rely on systems, not your feelings.
This is where systemic investing becomes your secret weapon. All it means is that you create a clear, predefined set of rules for yourself before you're in the middle of a high-stress situation. This plan tells you exactly what to do, whether the market is booming or busting. You're basically making decisions for your panicked future self while you're still calm and rational.
Look, if you remember just one thing from this whole explainer, let it be this. Your emotions will betray you when it comes to investing. They are wired for short-term survival, not for long-term wealth building. A well-thought-out system, on the other hand, is logical. It's consistent. It's designed to hit your goals and ignore all the daily noise. To put it simply, systems beat emotions. Every single time.
So how do you actually build this emotional shield? Well, it's really a simple three-step process. First, you have to just admit to yourself that your gut feelings are terrible financial advisors. Step 2, when you're calm and clear-headed, you create your rules. Maybe something like, if the market drops 20%, I will invest X amount. And third, and this is the hardest part, you have to trust the system you built and let it do the work.
All right, let's bring this all home. Let's talk about a practical, real action you can take today. We want to get out of the theory and get you your first small win in building a system of your own. So here's your challenge. Don't wait for the next market dip to figure this out. Your very first rule should be deciding right now, with a clear head, what your specific action plan will be during the next big downturn.
So what will that plan be? It doesn't have to be complicated. Are you going to invest a small fixed amount to take advantage of the sale? Or maybe your plan is just to do nothing at all, to not even check your portfolio and just ride out the storm. You know what? Both of those are perfectly valid strategies. The key is that you decide in advance.
At the end of the day, remember this. Having a pre-written plan is the ultimate hack to beat fear. It's the one tool that disconnects your emotions from your actions. It turns a moment of potential panic into a moment of clear-eyed opportunity. And it's what finally lets you follow that golden rule to actually buy low. Thanks for joining me.